How far can property values really fall? This is not a doomsday video. It's just asking the question, if property prices were to fall, how far could they actually fall? Generally speaking, property values are very slow to fall. Even in the 2008 crash, it took 4 to 5 years for property and home values to reach the bottom. It's very uncommon for property and home values to fall by more than 10% in any one year, even if there is a crash. But could property values ever fall to 2012, 2013 levels ever again? Or what is the lowest value they're likely to fall to if there was a crash? Hopefully you've been following this channel for a while. If you have, you might know some of my career history and some of my background. If you don't, make sure you subscribe to the channel now and give the video a thumbs up while you're at it. But between 2009 and perhaps 2012, I was working for IBRC, the bank. At the time, I had to value some very difficult assets. When it comes to valuing property, there are generally two common methods used: the comparable sales method on the residential side and the investment or yield-based valuations on the commercial property side. There are other valuation methods that can be used, including discounted cash flow. You also have the residual method, which is generally used for development sites. You also have the profit method, which is sometimes used for hotels. And you also have the replacement cost or construction cost method, which is sometimes used for things like hospitals, schools, and colleges. I bring up these methods because back in 2010, 2011 and 2012, there were very few transactions actually happening within the market, and therefore there was a lack of evidence, which meant using the comparable method or even the investment yield method were not always that reliable. Therefore, I relied on some of the other valuation methods to help proof check some of my work and build up a case for the value. Around 2012, a lot of assets started to be picked up by investment funds, and generally speaking, the price that they paid was in line with the replacement cost of the building, and in many cases actually lower than the replacement cost. Therefore, they were picking up these buildings or these assets and basically getting the land for free. This actually marked a turning point around 2012, 2013 as transactions started to pick up. People became more confident in terms of what they were buying and what values they were actually putting on those buildings and assets, and therefore they felt they were getting good value for money. Even on the residential side, this was evident as well. Build cost for an average small home in Dublin city centre around 2012 would have been around 157,000. The average sale price for a similar small home in Dublin at the time within the city centre was about 155,000. Larger homes in Dublin suburbs would have cost around 300 to 375,000 to rebuild in 2012, and the average sale price for a similar type home in Dublin suburbs in 2012 would have been around 340,000. Similar market conditions played out across the country on both the residential and commercial markets, where replacement valuations were in line with market valuations and market prices. Once this actually happened, the market started to shift and property prices started to increase. Comparing a similar situation to now, if prices were to crash, I'm not saying prices are going to crash, I'm just saying what if prices were to crash, what would happen in the market? If we were to look at some historical data as well as current construction costs, the standard build costs for a small average home in Dublin city centre is approximately 250,000 at the moment, and perhaps as much as 550,000 for Dublin suburb homes, or even far higher for some larger homes. The cost of delivering a 2-bed apartment in Dublin ranges from 359,000 for a low-rise apartment in the suburbs to as much as 619,000 for a high-end apartment in the city centre. The average price for a home in Dublin at the moment is about 500,000. There's obviously going to be homes that are far higher value than that and far lower value than that, but that still allows for a situation where the replacement cost for a property is going to be lower than the actual market value, particularly when it comes to apartments within the city centre. This suggests that perhaps there is some value to be had in some properties out there based on the replacement costs. This also suggests that markets wouldn't have to fall all that much for properties to be valued lower than their actual replacement costs. This wasn't the case back in 2007 and 2008, as values were far higher than their replacement costs. If there was a major crash, construction costs will likely drop, but I think any drop in construction costs will only be marginal. It's also likely that investment funds would keep buying assets if the value falls below their replacement costs, because they would see it as good value for money. Therefore, I do not believe that prices will fall back to 2012 levels even if there was a crash. The chances of them falling back to 2012 levels are extremely slim unless there is a major economic crisis or crash, something like we've never seen before. I'm not saying real estate prices can't go down or will never fall. All I'm saying is, with construction prices so high at the moment, some properties offer good value. And this is another factor to consider when you are comparing current prices against 2007 prices. If you are interested in real estate, I'm always putting out new videos, so make sure you subscribe to the channel. Also, there's a few additional links down below. And as always, thanks for watching, and don't forget to hit that like button.